Hey guys, welcome back to another video. I hope you're having a wonderful week, remaining profitable and staying safe. Now, as usual, on Fridays, we take a look at what happened to the freight market last week and what we can forecast for next week. Now, if you're new to this video, welcome to an awesome community. I do videos on the spot market and freight market as we try to navigate through this less than ideal situation in the trucking industry. So if this is a topic that interests you, feel free to subscribe down below. All right, guys, now we're going to go to the board and look at the capacity insights for the week. We'll see what's going on in the freight market in general, what's happening with diesel, and then we're going to go into more specific data for flatbeds, dry vans, and reefers. Ready? Let's go. Okay, so for the past few weeks, I have been including this weekly capacity insight into this weekly trucking video, right? So for this week, and we're looking at week 29 here, we have our voluntary revocations, our involuntary revocations, reinstatements, new authorities, total carriers lost, total carriers gained, and change in the net population. So if you can see, the change in the net population was negative 377 carriers. This is how many carriers we lost last week. Now, I also have this chart just to keep tabs just for my visual folks. Red line is revocations, involuntary ones. We can see that they're pretty low, but they're stable. New authorities, green line, they did go down last week. Voluntary revocations and reinstatements went down. And the black line right here is the change in carrier population. Now, it's much better than last week where it was only 50 carriers lost, but nevertheless, it's not a lot of carriers are leaving the market if we look at it from a net perspective. Okay, now let's talk about outbound tender volumes and outbound tender rejections. Blue line shows us the general freight volume in the market, right? The higher it is, the more volume there is. The white line, the tender rejections, show us how much of that freight is actually being rejected by contract carriers and getting pushed to the spot market. Why do carriers reject freight? Not enough capacity, better alternatives, whatnot. It could be a billion different reasons. So currently, this is where we are right now. We can see as of July 9th or so, volumes started increasing. They continue to increase, which is nice. And the tender rejections started increasing around July 17th or so. Now, this is all great. They did plateau over the past day or so, but currently the tender rejections are just at 3.17, which means that only 3.17% of the total freight is actually getting rejected and getting pushed to the spot market. So we can't expect spot market volumes to be amazing. That being said, here's another chart. Same chart, we're just comparing over a week, and we can see that from a week ago, the volumes went up by 4.8%, and the rejections actually went up by 9.3% over the last week. So we're moving in the right direction for sure, but it's just happening very slowly and it's not consistent, right? Sometimes rejections go up, sometimes they go down. All right, let's take a look at the spot to contract spread. And this is showing us the difference between spot and contract loads and what they pay. So currently we are at negative 72 cents. This means that on average, contract rates pay 72 cents more than the spot market. And of course, this means that contract carriers are not going to be motivated to reject freight for a better alternative on the spot market, right? They're hanging on to that. But we can see that the gap is slowly closing between those spot and contract rates. All right, now the thing that really concerns me more so than the volumes or the tender rejections, it's the diesel prices. So as you can see right here, this is the diesel truck stop actual price per gallon. For those of you who don't know, I get these charts from Sonar. So here it is, and we can see that since around July 10th, right here, diesel prices have been going up, bouncing up actually. And look at that, since the 24th to the 26th, they kind of skyrocketed. Whoops. And currently diesel prices are at $3 average, $3.95 per gallon. So this is really concerning me because with spot market rates still going down, as we will see, and with diesel prices, which is one of the highest variable expenses out there, going up, yeah, it's concerning. I'm not going to lie. If we look at this chart right here, this is diesel prices, and we can see that it's green. Green means that there was an increase in diesel prices. By how much? There is a percentage, right? And I'll attach all of these charts down below for you guys. But yeah, it's green, which means that pretty much all markets except for Buffalo, New York, Rochester, New York, Phoenix and Flagstaff, Arizona, Joliet, Illinois, Syracuse, New York. If I'm mispronouncing it, I'm sorry. Also Las Vegas. But everything else, diesel prices went up. And that's a little bit scary. Okay, now let's take a look at some specifics, starting with the flatbed spot volumes. How much volume is there for flatbeds on the spot market? Now, the good news is that we're sort of following the 5-year average, which is this black dotted line. We're right here, the blue line. The bad news is that volumes decreased quite a bit for flatbeds. So that's the bad news. Less volume means that more carriers are competing for that limited amount of loads available, right? And we know that capacity is not leaving at the rate that we would all hope. So this is not good news. And of course, as volumes dropped here, the spot rates for the flatbed did follow. This is the third week. This is as of last week. Third week that spot rates for the flatbed are going down continuously. The only good news is that we are following the 5-year average. That is good, but we're below it, right? Currently, flatbed rates are at $2.40 per mile on average, whereas the 5-year average shows us like $2.57 or something like that, $2.50 some cents per mile average. Now, yeah, I mean, if the 5-year trend continues, not much good is going to come for the flatbed market, but we shall see, right? I'm not going to be a doomsdayer here. All right, finally, let's take a look at the DAT market map for flatbeds. As a reminder, we're looking at where is a relatively better place for flatbeds to end up if we're talking about the spot market. Red means tight capacity. There are way more loads than there are trucks. Blue means the opposite. And we can see that still for the flatbed, it's the South, right? The South and parts of the East Coast that are the best chance you're going to get, right? So yeah, the South. And then we have the Pacific Northwest, Oregon, especially Oregon. There are way more loads than there are trucks there. We were in Oregon just a week ago. So yeah, but the only problem is that if you're going from Oregon somewhere to the West Coast, you're golden. But if you're trying to get out of Oregon or Washington, going to somewhere like Texas or Mississippi or Arkansas, yeah, you're going to want to pass on that load because it's not going to be paying well. But in general, not much has changed for flatbed. The only thing I can say is that the market is deteriorating a little bit, right? Dallas right here is not as red anymore. Louisiana, which is a very big surprise to me. Georgia, South Carolina is okay. Portions of South Carolina are deteriorating. So yeah, it is what it is. Now on to dry van spot volumes. Again, it looks like we're following the 5-year average, which is good. The spot volumes decreased ever so slightly, if you can even tell. Yeah, you can tell. Ever so slightly. But if we continue following the 5-year average pattern, then we can expect that volumes will start slowly increasing for dry vans. Now, what about dry van spot rates? Well, this is the 4th consecutive week where they are going down. But again, we are following that 5-year pattern. And if we're looking at it, then we can expect that rates will slightly improve if we're lucky. Currently, dry vans are around $1.80 something per mile on the spot market, whereas we should be somewhere around $2 and I don't know, 10, 15 cents or so. So we are way below the 5-year average. But now let's take a look at the general market to see what is happening with dry van volumes. So we have this map right here. And what we're looking at here is the change in volume from last week as well as general volume. So the height shows general volume in the area and the color shows us whether it decreased or increased. Red means a decrease, blue is an increase. we can see that for the most part, the dry van market is red, right? So there are a ton of volume decreases. There are some areas, the gray areas, where there was no real change. Looks like the Phoenix, Arizona market had an increase in volume. And then everything else, Idaho, Montana, North Dakota, Minnesota, North Platte, Nebraska, portions of Alabama. Yeah, there were increases in volume, but look how flat those areas are, which means that it doesn't matter. You shouldn't be caught dead in a place like North Dakota at the moment with a dry van. There's just no volume there. Now let's take a look at what is going on with the rejection rates for the dry van, and this map works in the same way, right? Red means a decrease in rejections, blue means an increase. It's a little bit more interesting, but still predominantly the map is red, which means that pretty much across the board, the rejection rates have decreased since last week. But there are some places where there was a nice increase in rejections. For example, the Albuquerque market, the North Platte, Nebraska market. There was, I believe this is the Fargo market. There was Virginia and portions of West Virginia, Mississippi, Arkansas, portions of Louisiana, and even Texas. There were some increases. Now, does that mean that these are the places you need to go? Not necessarily. We're going to take a look at where you need to go if you have a dry van in just a minute. But before we do, let's take a look at the heat map by DAT for dry vans. If you remember, I said red means good. There are more loads than trucks. Blue is bad. So we can see, okay, California, Dallas, Memphis, Atlanta, Charlotte, Pennsylvania, pretty much all of Pennsylvania, Indiana, portions of Ohio. That's where you are going to have more negotiating power. That's where there are more loads than trucks. However, something that you also have to consider is a market like Dallas, for example, right? It's red. There are way more loads here than there are trucks, super tight capacity. But it is surrounded by completely blue market areas, which means that everyone from Oklahoma, from somewhere in Midland, Texas, wherever it is, San Antonio, whatever, they are going to be deadheading here. And that means that capacity will increase. There will be more trucks, more competition, even though they're not posted out of Dallas. And that means that those rates are not going to be as amazing as this map would lead you to believe. Okay, so where do you have to go if you have a dry van next week? And as a reminder, this map shows us volumes, which is the height of a market area, and rejections, which is the darker blue it is, the more rejections. What we're trying to do is we're trying to marry two things. We want high volume and as many rejections as humanly possible, because that means that there is a ton of freight and a lot of it is getting rejected, so the volumes will be higher on the spot market. So we have Wisconsin, which is super dark blue, which means that there are a ton of rejections happening there. Wisconsin has been a decent market for a while. We have Arkansas, we have portions of Mississippi, Illinois, Missouri, we have Virginia, right? Portions of Pennsylvania. Now, even though California is actually not as blue as everywhere else, this is definitely a market I would check out just because of the volume. The rejection rates are not as high as in a place like Wisconsin, right? Or Arkansas. But the thing is, there's so much volume that it makes up for it. There's more volume, a little bit less rejection, but because of the amount of volume, still a lot of loads end up on the spot market. The only thing you need to be careful of in California, Arizona as well is interesting. The only thing you have to be careful of there is, of course, the fuel prices, because it doesn't matter what the gross income is. The only thing that matters is what is the net income. But yeah, if I had a dry van, California, maybe Arizona, Wisconsin for sure, some southern states, maybe hitting the Midwest, maybe hitting Virginia at some points. Okay, finally, we have reefers, starting with the spot volumes, and actually it was a tiny increase for reefer spot volumes, which is nice. And it's following the 5-year pattern. We can expect that volumes will continue increasing slowly and then will jump at the end of the year. So that is good. Now, what about spot rates? Well, unfortunately, spot volumes did not translate into spot rates. Rates are on a decline for the 4th consecutive week. And currently, even though we are following the 5-year average pattern, Currently, reefers are at an average of $2.25 per mile, whereas the 5-year average is $2.50 for this time of year for a reefer, 25 cents less per mile. That is brutal. All right, let's take a look at volumes, general freight volumes for the reefer. It always makes me so sad because reefers, it's like when you look at volumes, you really get sad for the reefer because, I mean, it looks like a dog or cat with alopecia. It's missing things, right? I mean, I'm sorry, my imagination goes wild, but for the most part, it's either gray, which means that there was no change in volume, or it's red, which means there was a decrease. Especially look at that in California. There was a decrease, and also in the Pacific Northwest, decrease or no change. North Platte, Nebraska saw an increase. There were portions of Georgia, portions of, what is that, Vermont, some blimps in the Midwest, but in general, you see these places are flat. That means that there's no volume there in general. So yeah, not great for reefers, unfortunately. Let's take a look at the rejection map. Now, this is a little bit more interesting, although predominantly it's gray, which means that there was no change. We can see rejections increased in North Dakota, Minnesota, Iowa. We have portions of Kansas, like a little corner there, Kentucky, Tennessee, North Carolina, Virginia, maybe portions of South Carolina as well, upstate New York, Houston, Texas, decrease in terms of rejections. California, the Pacific Northwest is not doing so well in terms of rejections compared to last week. Does that mean that these are places not to go? Not necessarily. We're going to look at where you need to go to grab relatively better opportunities next week if you have a reefer. But again, first, the spot market. So something I realized with the reefer, and it's actually true for the dry van as well, good areas are few and far between, and that is a big problem, right? So good areas for a reefer are the red ones. We have the California area, more central and northern California. We have the Pendleton, Oregon area, which includes Grandview, Washington, Idaho. We have portions of South Dakota, Michigan, Grand Rapids, Michigan. This place where Missouri, Tennessee, and Kentucky come together, right? There are portions in upstate New York, right here as well. But these areas are few and far between. And the biggest problem is, well, first of all, in an area like this, all of these people who are in a blue market area where there are not enough loads, they're deadheading here and kind of screwing up the load to truck ratio, right? But the second thing is finding lanes going from hot market to hot market, right? From California, you can go to Pennsylvania for a decent rate. But from Pennsylvania back to California, you're going to go for less than $2 per mile, like $1.50 or so. So that's the biggest challenge. Yes, there are some markets where you can have negotiating power, but getting to those markets and getting from hot market to hot market is really, really difficult. All right, so where do you have to go to grab relatively better opportunities next week if you have a reefer? So as a reminder, again, we're looking for a place that is elevated, a lot of volume, and as dark blue as possible, preferably like Iowa, right? That means a lot of tender rejections. So for reefers next week, the Pendleton, Oregon market right here. It has volume. It's not a huge amount of volume, but it has volume, and the rejection rates are more or less relatively decent, right? And this includes the Grandview, Washington area. Idaho might be it. California actually doesn't have such high rejection rates, but the volume there is insane compared to other places. So a market worth checking out. Then we have the Dallas, Texas area, Missouri, Iowa, Omaha, Nebraska, maybe. I think this is Sioux Falls, South Dakota, Indiana, Wisconsin, maybe. So yeah, if I had a reefer running right now, then I would be keeping, I mean, ideally, honestly, I would be going from California to Washington because it pays good, and from Washington back to California. This would be ideal. But the thing is, if you want to run that, you have to grab a calculator and start punching in some numbers because you have to know that the fuel price in California is through the roof. And another thing you have to know is that in Oregon, the tax, the IFTA tax is zero, right? The diesel tax is zero. So you can't even benefit for running or refueling in Oregon when it comes time to paying those IFTA taxes. So yeah, this is something you'd have to calculate. This is the ideal scenario. But a better scenario, although it's very hard to find those lanes, right, is California to maybe Dallas, Texas, or maybe portions of Oklahoma. The problem is from here back to California doesn't pay well, whereas from California to Washington and back pays relatively better. But again, those fuel prices offset everything. As for our experience this last week, nothing particularly good nor anything particularly bad happened. It was pretty boring, but this month in general is an interesting month. This month, due to the excessive repair expenses, some of which were covered last month, we are basically working to continue covering those expenses as well as those that flow, while you operate this business. Fuel, tire service, truck payments, trailer rental payments, insurance, and all of that great stuff. Basically, we're right now in a position where we're trying to cover pretty much 2 months worth of expenses because of those crazy repairs. Remember how I said in the last video, I believe, that you have to guard your cash flow with your life? Well, this is me guarding mine. And given that we had no excessive or weird expenses this month, I anticipate that the month of August is going to be much, much better than the month of July. But for now, we're just dealing with issues as they come along. Sometimes you work for profit, other times you work for cost. Is it worth it? Heck no, it's not worth it. If you work for cost every single month, what kind of life is that? You're spending your life in a truck and not even making any money to take home. But for us, this is the first and hopefully last time we are going to be doing this. Usually we make a profit. There was 1 month out of the 4 years where we had a loss, which was in April of 2022. But other than that, we have been managing. But again, if you're working for cost or for loss every single month and you're spending all that time in the truck and bringing no money home, no sane person will tell you that it's worth it. Remember, work hard, play hard, and to play hard, you have to have some money. Anyway, guys, thank you so much for watching. I know I babbled your ears off during that last segment, but I hope you have a wonderful rest of your week, a wonderful weekend, and I'll see you in the next video.